Hey, welcome back to another portfolio reveal. This time I'll be summarizing both January and February together, or else I'll never be able to catch up on these videos. There were several changes in the last 2 months where I shuffled around $11,000 within the portfolio by selling out of some of my original holdings when I first started the portfolio, and to continue transitioning the portfolio to more index and technology based. If you'd like to understand more about the changes or trades, feel free to watch the last video for more details. In this video, I'll also be going over my personal Google spreadsheet that I've been building for the last 2 years now, and provide ideas on how to look at your own portfolios based on what I'm tracking on my own spreadsheet. It's become quite robust now, and for someone who loves data and information, this has been helpful in staying motivated and aiding in the decision-making process of where and how to invest. The greatest thing about dividend or passive income investing, and why it has worked for me and so many others, is because it's recurring and predictable, which makes it easy to keep track of in a spreadsheet format and make projections from it. This allows you to build and plan your portfolio around your own investment goals or time horizon, and then work towards it one step at a time. Okay, let's quickly get into the portfolio because there's a lot to go through. So to start off with all the transactions from the non-registered account that were made in the last 2 months, if we filter by January and February, we can see that I deposited $1,200 into the portfolio, with 71 cents of it paid out from Wealthsimple from stock lending. Then for dividends received, I was paid out a total of $1,173.71 in dividends. For the purchases I made, as mentioned, you can find most of them in the last video I posted, but here I can quickly filter them for you to see. On the far right column for the lot value, you can see how many of them are in the green or in the red. One thing I like to do for fun is to just highlight the entire column and get a sense of how the purchases have performed from the past months. It doesn't mean much because we're investing for the long term, but it's good to know that they've been in the green. Moving on now to the dashboard, we can start with the portfolio details on the left side. First, with the portfolio value, it has been hovering around $80,000 for a while now despite the overall market going up, and this is mostly due to Tesla's recent sell-off, negating any of the gains from the other holdings in the portfolio. With a 10.67% weighting, the volatility of Tesla will have a greater overall impact on the portfolio when it goes up or down. While I still believe in Tesla's long-term potential, I don't want to be overweight on it too heavily, so I'll likely add to this position a little bit more at these lows, but we'll also want to offset it by growing the index ETF positions to a greater allocation in the near future. In terms of deposits, I've invested just over $69,000 into the portfolio so far, and I keep track of this as the baseline of the portfolio's performance. If the portfolio value falls below this number, that is a big warning sign because it means I'm starting to lose money on my initial investment instead of growing my money. So I want to make sure it stays above this at all times. And then for the dividends I've received since starting the account, we're at $5,861.04. We can expect this number to at least double by the end of this year because our annual dividends at the top right corner projects us earning an additional $7,800. If we take out the $1,000 or so that we've earned in the first 2 months of this year, we can look to add about $6,600 to the total, which will put us at over $12,000 in lifetime dividends at the end of the year. Below this section is a list of the upcoming ex-dividend dates and the scheduled dividends being paid out to us next. These will highlight on the day that they are due or paid out, so it serves as a reminder to invest or for you to record the dividend into the spreadsheet. Next, we get into the sections where we see an overview of how the portfolio is divided up or allocated. This first pie chart shows the distribution based on the number of stocks in each sector, and we can see that we have a majority in the technology sector, then financial services, and ETFs rounding out the top 3. We can see how each one has been performing based on the amount that has been invested and what has been returned so far from a capital standpoint, a dividend standpoint, and most importantly a total return standpoint. As we can see, most sectors are performing well. The ones that are underperforming are the communication services sector, the utility sector, and the energy sector, which is about break even. I find this most useful in visualizing how much I've invested in each sector and how much has been returned to me so far. Now moving on to the high-level summary at the top, as mentioned in the last video, the day P&L is what fluctuates each day from the stock prices going up or down. So it's not a metric that I look at too closely, but we can see that February 29th was a good day and we saw the portfolio go up $483.81. The next 2 boxes here carry more weight when it comes to the overall performance. First is the total P&L, which comes from the total value from the stock prices going up or down. This value is important because it tells me based on the amount I have currently invested in the market if it's growing or losing me money. Keep in mind that this value doesn't factor in the dividends I've received and the profits I've made from buying and selling. So if this total P&L value turns red, I'd be concerned, but it's not the end of the world as long as the total return box on the right is in the green. It means I'm still up overall. This total return box here is the most important metric I look at on a daily basis to see whether or not the portfolio is performing as intended. This total includes the total P&L from the previous box, but also the lifetime dividends and any profits or losses that were actualized from buying and selling. So as long as this box is green, it means that my investments are paying off, and if this becomes red, then either the market has experienced a catastrophic sell-off, or I need to look at reevaluating my holdings closely to figure out where it went wrong. Ultimately, this box should always be green, because once it turns red, then it means I've started to lose money from my total deposited baseline value. One of my goals for this year was to eventually see the dividend yield value hit 10% or higher by the end of the year, but with all the changes I made and with the Tesla sell-off, this happened a lot sooner than I thought. This number will fluctuate though, so if we continue to see a big rally in the market, then the yield will drop lower because they are inversely correlated. But that will mean that the portfolio is seeing a gain in value, so that's okay. I've also built into here a drop down if I wanted to look at the dividend yield on cost instead, but generally I leave it at the overall value. Personally, I would like to see this remain consistently above 10% because of the pace it would allow the portfolio to compound at, so I'll be watching my allocations a bit more closely to try and maintain the yield above 10%. I already mentioned this a bit earlier, but this last box here is the annual dividends, which tells me how much I can expect to receive from dividends each year. This number will go up or down based on the dividend increases or decreases throughout the year, or as I invest more into the portfolio. My main goal for this is to try to get to $12,000 as quickly as possible, as that would mean the portfolio will average around $1,000 received per month in dividends. Now moving on to the charts, we'll start with the portfolio value history chart, where it compares the portfolio's value over time and total invested value. This visually shows whether or not your investments are above or below how much money you've put into the market so far. As you can see, generally the portfolio value should be above the total invested line, but as we saw last October when we had a massive pullback and the market sold off heavily, it could potentially dip below when that happens. Next, we'll go over the two charts that compare the portfolio's value and returns in relation to the TSX index and the S&P 500 index. Both charts track the same four values: OSPTX, which is the TSX index, INX, which is the S&P 500 index, then the capital return and total return values are the same as the ones shown in the summary above. In the line chart, we can see the lines crisscrossing early on, but we're starting to now see some separation as the market started to rally heavily since October. On the bottom of the chart are triangles, which is an addition I added to see when I was making stock purchases. This is meant to be a reminder that ideally you want to be buying when the market dips or pulls back instead of sitting on the sidelines with cash and lose out on those gains. For the bar chart, it is a live indicator of the indexes and portfolio's performance since a specified inception date. So if we scroll down a bit, we see that the inception date for the portfolio was 19 months ago on July 21st, 2022, which is when I made my first few stock purchases. While this is great to look at for a point of comparison, it isn't entirely accurate because over time I've made many changes to the portfolio, so from a comparison standpoint, we aren't exactly comparing the same initial holdings at the portfolio's inception. So while I like to look at this chart as a point of reference, I also remind myself that it's not an accurate reflection of performance. Now continuing downward, we can see the projected monthly dividends and get a sense of what we should be expecting in the coming months until the end of the year. There's not much to add to this. The only thing I'll look at is that the dividends keep increasing over time, and then what would be the minimum amount of dividends I can expect to receive each month. Continuing on with the projections, the next chart is a rough growth estimate of the portfolio in the next 10 years. Many factors may change the pace at which these goals are met, but it gives a good idea of the trajectory if we continue with the plan we set out to accomplish. We'll now go through all the holdings in the account and just give a quick summary of each one. Aduro Clean Technologies is a small cap investment in the industrial sector and has been showing some promise and releasing positive news lately as it develops its technology in treating and recycling waste plastics among other environmental applications. I've been making small additions to the position as it's gained some traction in the past few months. Apple has not had a good run lately and pulled back a bit due to its earnings. They haven't performed as well as the others so far in the tech sector this year, so I may want to add more to this position when it goes down some more. Microsoft is a new holding in the portfolio, and so far it's just a starter position. I'll be looking to add and grow it out some more this year. Amazon has been the best performing stock in the portfolio at the moment, with a total return of 66.03%. It's gone up so much despite being the smallest tech position in my portfolio, but looking at Amazon, it still hasn't even hit its all-time high yet, so there's still room for growth. Google has been another good performer so far, and I'll likely add to this position with this pullback recently. So after being the best performer for all of last year, Tesla sold off massively after its earnings report due to the lower guidance for the rest of this year and until its next growth spurt expected in 2025. This one hurts a lot as it's my biggest position in the portfolio, but at the same time it's not unexpected due to how volatile Tesla stock is as a whole. The silver lining is that because of all the dividends collected as a hedge throughout my time holding the ETF, I'm at about break even with a total return of 0.64% because I collected $1,031.30 so far in dividends and continue to get paid each and every month. ATD continues to be a strong performer, and back in December they increased their dividend by another 25%, which is consistent every year so far since 2020. I bought into Brookfield Asset Management as a starter position when it dipped last year, but never got around to adding more to it before the price recovered. It's quite a bit higher than my average at the moment, so I'll probably hold it for now until there's another opportunity to add to it. This used to be BKCL, but in the last video I had swapped it to Bank, and so far it's just slightly negative, so there's nothing to report here yet. The telecommunications sector hasn't done well last year, and they're still having a bit of trouble recovering. In Bell's recent earnings, they announced massive layoffs and a big restructuring of their business. Despite the bad news, they still raised their dividends for the coming year by 3.1%. This is a decrease compared to their previous average of around 5%, so hopefully this is not a sign of significant underperformance ahead. Brookfield Renewables is a long-term renewable play that I don't expect to see returns in the immediate future, but I hold it for its consistent dividend growth of over 5% every year. In the current interest rate environment, it has been difficult, but once rate cuts start, then we may start to see a recovery in the sector. It's been a struggle for the utilities and energy sector, and CPX is another position I continue to look at averaging down on for its dividend growth of 6 to 7% each year. They raised their dividend again by 6.03% in October of last year. This is another renewable energy play and one I plan to hold for the long term. With their recent acquisition news, Enbridge has become North America's largest natural gas company. The stock has been an underperformer for the past year, and I've been averaging down on it for the recovery and the consistent dividends. If you look at the dividend history, they've only been increasing their dividend at a rate around 3% per year, so there's definitely been a slowdown. But at its current dividend yield of 7.85%, this is still providing solid income generation. I'll continue to monitor the holding, but this may be transitioning from a long-term holding to maybe medium-term holding, depending on the performance in the next year or so. Or this could possibly be a candidate for consolidation into ENCL, as it's already inside the ETF. So this is actually a duplicate position. ENCL was a new addition at the end of December, and so far it's provided a total return of about 5.38%. In these first 2 months, I've already been paid $73.08 in dividends, and once the energy sector starts to see a recovery, we should see the capital appreciation jump as well. For GoEasy, the earnings they just released were good and it remains one of my best performing stocks in the portfolio that I'll continue to hold. GWO has been in the green the entire time since the recovery started in 2022. It's a small position that I never really paid much attention to since it was always green. I have no plans to add to this, and I've had thoughts of taking the profits because it's near its all-time highs and reallocating it elsewhere. I bought into HTAE near its inception while the tech sector was near its lows in 2022, and I'm glad I did as the recovery has made it one of the best performers in the portfolio. I consolidated TXF into this holding as per my last video, and has continued to grow as this AI semiconductor boom has kept the bull run going higher and higher. I mentioned this in the previous review video, but in December I added more to HYLD because of the news about the changes they were doing and in anticipation of the growth potential now in the ETF. All of the additions I made have been in the profit so far, and we're starting to see the changes materialize in my capital return on the position as the market continues on this bull run. It was also announced that there will be a 7% increase in the dividend starting March to the amount of 13.1 cents from its previous amount of 12.1 cents, along with a permanent reduction in the management fees to 0%. This ETF just keeps getting better, and I'm glad I held onto it through its dividend cut last year. When that was announced, I had lost a bit of interest and stopped adding to my position, but it's now moved into probably the top spot again with USCL. And I fully expect a lot of growth going forward because of the size of my position and as the market trends upward over time. To give a quick comparison of how HYLD has performed since the last video, we can see the total P&L, which is the capital return, has increased from $206.32 to now $575.50. From a total return standpoint, it was 14.17%, and now it's sitting at 21.42%. As the largest bank in Canada, Royal Bank has recovered nicely and has stayed positive while continuing its biannual increase in dividends last month. Although the increase is a little smaller, it continues their 12 consecutive years of continuous dividend growth. There's not much to say about TELUS. Similar to Bell, it still has some ways to go before going positive again. But as long as they keep steadily raising their dividends biannually at about 6 to 7%, I'll keep holding and wait for that recovery. With dividends included, I'm only down 3.42% currently on this position. TD hasn't performed as well as Royal Bank, hovering around break even right now, but they just had another dividend increase of 6.25%, so I'll keep holding and collecting the dividends. I started my USCL position in December to gain more exposure to the S&P 500 and for adding some more stability to the portfolio. So far it has performed much better than I had expected and has continued to track very closely to the S&P 500 index. For comparison, from the end of December until now, the position was down $62.36 and from a total return standpoint was down 1.96%. Now it's up $219.51, and including dividends paid, up 4.97% in terms of total return. I've been enjoying watching this position continue to grow and look forward to seeing where we'll be at in a year from now. Now to get into the charts for this section, some of them are a repeat from the dashboard, but many of them dive deeper into each individual holding to give context and some surface level indication as to whether or not the stock is relatively expensive or inexpensive at this point in time. I use these to help provide some guidance as to where I might want to invest, but it should in no way replace proper fundamental analysis. There is some complexity that went into creating some of these charts, and you might read into it a bit differently than I do, but I'll go into some detail for each one, and if there are any questions or new insights that you might have, feel free to leave them in the comment section below. Starting with the pie chart for sector distribution, it is the same as the one on the dashboard page, so there's nothing to add here. The next one is a donut chart showing the total portfolio value in the middle, along with all the holdings and how they're allocated. Then we get to the projected monthly dividends bar chart, which is again the same as the one in the dashboard, so nothing new here as well. Beneath that are the bar charts for the individual stocks in the portfolio, with the left one being the individual stock price return performance, where it shows how each individual holding has appreciated or depreciated in price since I've invested. We can see that there are some holdings near or past the 50% mark, and then another group that is between the 20% to 40% range. Overall, the performance of those with the green bars have outperformed the collective total of those who have underperformed. Some people may look at this at the end of the year when reviewing their portfolio and use it as a means to see where they might want to trim some positions or to take profits to reinvest elsewhere. Now on the right is the current dividend yield versus the 4-year average dividend yield chart. This chart may be a bit hard to comprehend at first, but this shows whether the current yield is higher or lower than the historical 4-year average yield. So you have an indication of if it's a good time to invest and lock in a higher yield than the 4-year average, or you should wait for the stock price to drop a bit to get in at a better yield. This isn't black and white where you should invest primarily based on this metric, but it's just one way of looking at which stock is currently undervalued in your portfolio. To read this chart, the green and red areas visually show how much or how little it is above or below the 4-year average yield. If we look at YTSL for example, this means that the current yield is 25.7%, but the average yield is 20%, so it may be a good time to put in some money and lock in that higher yield. Whereas if we look at GWO, we can see that it is currently yielding 5.311%, which is below the 4-year average yield of 5.61%. So it might mean that the stock price has gone up and you might not be getting as much of a discount if you were to invest now. The values for these 4-year averages are manually inputted from what I could find on Seeking Alpha, but some of these are brand new funds and haven't been around for 4 years yet, so I've arbitrarily set some of them based on their initial yield at inception. The next set of charts are similar in nature to the bar chart I just showed. On the left is comparing the current price to the 52-week high and low. So the number value is the current price, and then the areas above and below are how far it is away from the 52-week high and the 52-week low. So let's say we look at GSY. Its current price is $166.49, and the light gray area above is how much room is left until it starts making 52-week highs. The darker gray area, sandwiched in the middle, is the range the current price has moved away from its 52-week lows, which is the top of the medium gray section at around $86. There are a few things that can be interpreted in this chart. If the darker gray area has a wide range like GSY does, then it might mean that the stock is very volatile and may have a higher beta value than the other holdings. If we go to the watch list tab, we can see that this is true and that GSY has a beta of 1.65. Overall, the market has a beta value of 1, so anything below 1 means that the stock is less volatile compared to the overall market, and a beta above 1 means that it's more volatile than the overall market. Now going back to the chart, another way to look at this is if the price is sitting at or near its 52-week lows, you might be getting into the stock at a good discounted price and can look at the light gray area as potential growth when the stock begins to recover. And vice versa, when the stock price is near its 52-week highs, then you may want to take a deeper look first into the stock to gauge if there's more growth potential, or wait for a pullback before investing again. Moving on to the bar chart for capital return and dividend return, this is to show how much of the total return from each stock was from the stock price and how much of it was from the dividends that have been paid out. If we use YTSL for example here, we can see that the capital return from the price is showing a negative $979.36 loss for capital return because it's below zero, but the dividend return is showing a positive return of $1,031.30. So it means that despite showing a strong negative return, the dividends received over time covers the loss and is showing a small profit at its current price. Now if we look at another example such as YMZ, we can see that in total the capital return and dividend return added together has passed $1,000 in total return. In the breakdown of this bar, the capital return is a much bigger portion than the dividend return, which can be interpreted as the stock has proven to be much more of a growth investment than an income investment so far, while still paying a strong 9% dividend yield. Another holding that was seen more as a dividend income investment as opposed to a growth investment is HYLD. Before the current changes, it has mostly been a dividend income investment as seen here at the end of December. The bar chart was composed mostly by the dividend return. But now we see that the capital return has seen some growth and has more than doubled, increasing to over half of the dividend return value and is now from a total dollar return value the number one holding in the portfolio. Another very strong performer is HTAE, where you can see from the capital return, it's currently sitting at $1,130.56 while still providing a high dividend yield of 9.66%. So with these examples, I think you can make the case that if you pick the right funds and the right investment strategies, you really can have the best of both worlds and see strong growth while also pocketing monthly dividend income at the same time. This next section is where I have some projections and goals I've made for myself and to keep track of the progress. The chart on the left is how long it'll take the portfolio to reach $100,000 in value, and my goal was to achieve this within the first 4 years of investing based on the contributions of $2,000 per month. So far I've outpaced the projection because I've been contributing more than the required $2,000 each month for the most part. And at this pace, we should reach the $100,000 mark by the end of the year. For the next two charts, they are based on projections I've made and set for myself each year. These metrics are tracked over time and presented here to also provide a more holistic view of the portfolio's progression and trajectory. So looking at the line chart for annual dividends goal, you can see that between $2,000 and $4,000 in annual dividends, it was growing at a much quicker pace than the rate between $4,000 and $6,000, where it has a more gradual slope. Some of that is due to the amount of deposits I was making and also the type of holdings I was adding to. I think in that $2,000 to $4,000 range, I was investing heavily into YTSL with its 20% plus dividend yield, and then between $4,000 and $6,000, I may have been investing in lower yielding holdings and also slowed the pace of deposits. Somewhere in between were also dividend raises and dividend cuts, which will also affect the chart. The large vertical jump you see between $6,000 to now has mostly been due to the changes I've been making lately. Those changes alone drastically increase the yield of the portfolio and will help it grow at a much quicker pace. The remaining charts on the right are for my target portfolio investment and is just tracking the amount of money I currently have invested in the market. This will continue to go up as I deposit and reinvest more into the portfolio. Then finally, last but not least, is the same line chart from the dashboard, but just larger so you can see the fluctuations a bit more clearer. Overall, I've been very happy with the returns so far from the changes that I've made, and to see them perform as intended right away so I can be assured of their long-term performance. There was a lot that was talked about in this video, and I hope that you found it interesting and a different perspective on how you might view your own portfolios. If you have any questions or comments, feel free to leave them in the comment section below and I'll get back to you. If you're interested in this content and would like to follow along, then subscribe and give a like on this video to help out the channel. Thanks for watching, and I'll see you in the next video.